When you face a drastic move with a fair value gap, a break of structure started with a liquidity grab, leading to the idea of this candle as a potential order block entry. But they only show up after smart money has already made its move. Instead, I use 3 specific technical rules based on the visible footsteps of major market players, including shifting candle closure. The first true signal that smart money is preparing to make a move before it actually does. Typically, most traders follow the old way. They look for drastic moves like this, which creates a fair value gap plus a break of structure. An order block must remain unmitigated and include a liquidity grab for it to be considered valid. But if you use this method and many of your orders are not getting respected, then something about this approach is wrong. For years, this method was unstoppable. Entire premium courses were built around it. From 2018 to 2022, it was printing money. But here's the shocking truth. It is already dead, and by 2025, it'll be completely useless. Smart money concepts like fair value gaps, break of structure, and liquidity grabs are incredibly useful. But when we apply these concepts to supply or demand areas, we're just creating a filter that leads to strong supply or demand zones. And that's the problem. If we want to make successful trades, we don't just need strong supply or demand zones, because the market is full of bigger whales and they can create stronger supply or demand each moment. Instead, we need to identify the order blocks that are actually controlling trends. So I've developed a new method. Its origins trace back to ICT, and it actually works. If you really want to learn this method the right way, you need to let go of everything you think you know about order blocks. I'm starting from absolute zero. When trading, you may have noticed that certain price levels trigger strong market reactions. These levels are known as support and resistance. A support level also acts as a demand zone as long as the price remains above it. If the price breaks below a support level, it transforms into a supply zone. Similarly, a resistance level functions as a supply zone until the price stays below it. Once broken, it becomes a demand zone. It is important to understand that supply and demand zones form within support and resistance levels. Their identity depends on which side, buyers or sellers, has control. Collectively, these zones are referred to as positions of interest because they attract significant trader attention, which provides a suitable position for becoming order block zones. So every support and resistance or supply and demand zone, which we considered as the positions of interest, can be considered as an order block, but not all of them qualify as order blocks, and for sure there are differences. So what exactly are order blocks? Here's the old definition. Order blocks are specific price areas where large buy or sell orders have previously been placed. The market has already tested and rejected these levels before, meaning they hold price significance. When the price revisits these levels, it often reacts again, creating potential trading opportunities. This is the best definition of an order block zone. But ironically, it's also the main reason our orders keep failing in these areas. Think about it. What guarantees that price will return to these zones? What guarantees it will react the way we expect? The truth is, there's no guarantee. So there is a better idea. If you identify a zone where a financial institution has already opened a buy position, just enter alongside them. But the old way will not help you because it shows the order blocks after they make their move. Instead, the new method will let us know where they will do this, so let's understand it better. Whenever a market reacts strongly to a price level, it signals that major players, such as institutions, banks, or professional traders, have executed their orders. Supply and demand areas can only be classified as order blocks if major players assert control and we observe their actions there. If you're paying attention, you'll notice something important. Based on this explanation, we're not looking for big orders. Instead, we're focusing on controlling orders. Big orders can create temporary spikes in price, but controlling orders, they dictate the trend. And if we can spot where institutions are establishing control, we can trade alongside them, not behind them. And this changes everything. There are 3 specific technical rules to identify valid order blocks based on the visible footsteps of major market players. Now, this is where things get serious. Rule number 1, confirm a shifting candle closure. Some candles move steadily in one direction from open to close, either bullish or bearish, with little hesitation. But others follow a different pattern. They start moving in one direction, bullish or bearish. At the last moment, there's a drastic shift, and they close in the near where they started, or in the opposite direction with a large wick compared to the body. Or they start with a drastic bullish or bearish move, then they slowly shift to get a close near where they started. If we zoom into a lower time frame, like 5, 3, or a 1-minute time frame chart, we can observe candles with a big body and small wicks compared to the previous, and these patterns are common in them. By carefully analyzing the open and close of these patterns, a clear pattern emerges. The hidden key to understanding institutional trading lies within this single candlestick. After we zoom in to a 3-minute time frame chart, there will be 20 candles, each candle representing 3 minutes of price action. For the first 42 minutes, the market moves steadily downward, Sell orders dominate the trend. But then at minute 42, everything changes. A major institution steps in, flipping the momentum, driving the price up in the final minutes, sometimes even closing bullish. This shift isn't random. It's a calculated move by smart money, revealing where true market control lies, which means an institutional or major player was pushing the price down with big sell orders, and a larger player, such as a large institution or a bank which has a plan to make a move, will enter long in the last moments and will not let them push down more than this. Sometimes this process can happen at the start of a pattern. These candles, shifting candle closures, are often the first sign that a bigger player than other big players is stepping into the market, and its orders will create the trends. This is important because recognizing these shifts can reveal that the big money has a move. Rule number 2, ignoring retail trades, the key to trading like institutions. The biggest difference between order blocks and usual supply and demand zones all comes down to who's controlling. We know that it is not retail traders, and it is the institutions that move the market. So ignoring retail trades is the key to trading like institutions. If you want to trade like smart money, you have to ignore retail noise because the crowd doesn't control price. Institutions do. So what actually creates retail and ineffective trades? A candlestick is just a visual snapshot of price movement over a set period made up of 4 key points: open, close, high, low. Now here's a question for you. If financial institutions truly control market trends, which part of a candlestick do you think they focus on the most? Most traders assume highs and lows, but that's completely wrong. Institutions don't care about highs and lows. Their true control lies in the open and close. Why? Because by manipulating the close, they control trader sentiment and create false expectations. Imagine, you enter a buy trade at the start of a 5-minute candle expecting an uptrend. The price moves up smoothly until minute 448. Suddenly, in the last few seconds, the price reverses sharply, closing below your entry. What just happened? Institutions waited until the last moment to trap retail traders, then shifted price to where they actually wanted it to close. Retail traders create wicks, institutions control the bodies. The wicks of a candle. That's where we see retail traders failed orders, chase breakouts, premature entries, and stop-loss hunts. The body of a candle. That's where institutions make their real moves. To trade with institutions, not against them, you need to start looking at price this way. If you want to truly identify smart money order blocks, stop focusing on wicks. Only the body of the candle should be considered an order block. Rule number 3, candle violation must be confirmed. There are 2 types of candle violations: bullish candle violation and bearish candle violation. Bullish candle violation occurs when the price trades the whole body of a bearish candle, decisively moves beyond its high, and closes there, signaling a potential momentum shift. The reason is, this candle shows sellers have control. When the next candle opens at this level, by the power of sellers, it goes down. But a bigger order will change all the retail calculations. This big order will form this bullish candle, which signals the entry of smart money, marking a strategic shift in market control and a potential trend reversal that can target higher liquidity levels. Here are the real chart examples. Every shift that results in an uptrend must include a bullish candle violation, which we will discuss it more in the next videos. A bearish candle violation occurs when the price trades the whole body of a bullish candle, decisively moves beyond its low and closes there, signaling a potential momentum shift. The reason is, this candle shows buyers have control. When the next candle opens at this level, by the power of buyers, it goes up, but a bigger order will change all the retail calculations. This big order will form this bearish candle, which signals the entry of smart money, marking a strategic shift in market control and a potential trend reversal that can target higher liquidity levels. Previously, when identifying an order block zone, we focused on the last candlestick before a sharp move that created market inefficiency. To validate it, we checked for 3 key factors: fair value gap, break of structure, and liquidity grab. But here's something interesting. If we analyze the pattern that forms from this rule, we may still see BOS, FVG, and liquidity grab. But none of these are actually required. Because this pattern alone tells us everything we need to know. A financial institution is actively controlling price. So far, we've solved many key problems in order block trading. Now, let's apply these rules. Confirm a shifting candle closure. Highlight it. Go to a lower time frame, like 5, 3, or a 1-minute time frame chart to see candles with a big body and small wicks there. Confirm the candle violation. Only the body of the candle should be considered an order block. So the violated candle's body is the order block zone. But there's a challenge that can ruin the trade. Sometimes the price will try to hit even our stop loss before reversing and continuing the trend. To fix this, we will need to expand the order block range below where the price was reached in 3 candles before. But there's another problem. Sometimes the price reverses too early, never reaching this candle zone, meaning our order never gets triggered, and that's a frustrating missed opportunity. Here's the fix. Let's not forget, our main goal in identifying an order block is to trade alongside institutional orders. To increase our chances of execution, we simply need to expand the order block range slightly, just by adding one or a few pips based on time frame. I've outlined the exact adjustments in the table below. Follow this and you'll see the difference. If you find this method challenging to apply, here's the solution. Flux Chart Group made this so easy for any trader, even for beginners entering the market today. By the help of this price action tool, all you need to do is use the link in the description, apply the indicator to your chart, follow its order blocks, and trade with confidence. We'll be sharing more updates and examples in upcoming videos, so don't forget to like, subscribe, and turn on notifications to stay updated. See you in the next one.